Even as firefighters work to control the Southern California wildfires, a new threat is emerging: landslides. At least one Pacific Palisades home split in two after being spared by fires. All this as the rise in homeowners' insurance costs draws attention. The Treasury Department releasing a report just yesterday that found costs rose by almost 9%. That's more than inflation between 2018 and 2022. The reason, the report says, climate-related natural disasters. Elise Greenspan follows the insurance industry for Wells Fargo Securities. Elise, welcome to the show. Welcome to Fast Money. You think it could go up to 40. Right now you're at 30 for insured losses, and it could go up to 40.
Yeah, and we've kind of, set expectations right now at around 30 billion of insured losses, with the expectation that things could rise to 40 billion. And to your earlier point, right, this is a loss that's really going to fall on the, personal property side. So really hit, homeowners insurers. We expect around 85% of that, 30 to perhaps $40 billion loss will fall on the homeowner side of things, which with a much smaller percentage on commercial property.
Mm-hmm. We had a stat in our intro about insurance costs rising. It's actually, they rose 9% more than the pace of inflation. So that's extremely steep. And it sounds like they're only going to go higher. Is there a point at which you're afraid that the industry is going to fall under scrutiny? It's like, because that is one of the big drivers of inflation in terms of all these inflation reports, insurance costs. That's not going down. Any pressure, external pressure on the insurance companies? I mean, there's really no way around it in some aspects of it.
Well, exactly. I mean, this is a heavily regulated industry, right? At the state level, right? Companies are filing, for in the standard market for rates that they would like to charge. And to the point, the reason that homeowners rates have gone up so much is that there's been a host of, different losses. When we look back, over this time period, right, we're talking about fires. There's been a series of hurricanes. There's been some states that have impacted by, winter freeze. There's been other fires that have impacted California. So it's just been a period of just elevated catastrophe losses for the industry that has really, led to this increase in prices.
So, Elise, they could either, to Melissa's point, be held under more scrutiny, or when you look back on these charts, and I don't want to belittle any of the tragedy that's happened. This has been immense. It's been horrific. But when you look at the charts on these names, we seem to get past it. And is it just a matter of the fact that they outpace inflation, the normal set inflation levels, or people just have a short-term memory and they do what they have to do as an insurance company to survive? Will they get past it at this point?
Well, look, I mean, our view, right, is even at this $40 billion loss, right, for the insurance industry, this is an earnings event, not a capital event, right? So the industry has the capital to absorb the loss. And then, when we're talking about prices going up, right, on the flip side, there will be price increases, right, where, losses is what brings pricing power in the industry. So there'll be greater price, that these companies can kind of, move past the event and potentially write more business in the state of California at higher prices.
So it used to be when there was a disaster, whatever the hit was, it was just an income hit, and then they were able to price higher. But now you have a different dynamic of people, or insurers, just wanting to leave the industry. We saw that already. How do you think the industry will rebuild or not as people rebuild their homes?
Well, this, when we talk about, right, non-renewals and, leaving the industry, that's been a situation that's been, much really pronounced in California than other states in the industry. And the way that, homeowners insurers have been able to, price in California has been different in other states, right? For example, primary insurers up until very recently could not pass through higher reinsurance costs. So if insurance carriers didn't think that they were, enabled to earn, return and charge appropriately for the risk, they were going to pull back from the state. But that being said, right, we're talking about standard market insurers, and there is a host of, California business that goes to the excess and surplus lines market where companies have been able to, charge a much higher price.